Hello there, class. It's Phil, the Mortgage Professor, brought to you by Mortgage Alliance. Mortgages are marvelous. So what's the class in today? Class, you're here for history. Why are you here for history? Because there's that old saying, if you don't learn from history, you are doomed to repeat history. So what history am I talking about? Well, just recently, in January, there were some changes in the Canadian mortgage marketplace as far as default insurance goes. Now, what were those changes? There are three. One said that in order to qualify for a mortgage, although you may want to have a variable rate, a 1-year term, a 2-year term, a 3-year term, a 4-year term, when you apply for a mortgage, and if default insurance is involved, guess what? The lender has to sit down and work his numbers out for your qualification based on as if you had taken a 5-year term. Is that a radical change? Not a major radical change, depending on the 5-year term rate that's being used at the day. But today, most lenders and most insurers are using at least the 3-year fixed rate as the benchmark for qualification. So is there a radical change? Stay tuned. It may be for you. You may be at risk, so you may have to act by April the 19th in order to get into housing. The other changes deal with refinances. You can go 90% of the value of the property instead of 95. That takes effect April the 19th. And the other one is, if you're the kind of person that's a speculator who likes to use other people's money big time, in other words, you only wanted to put 5% down to buy an investment property, well, guess what? After April the 19th, that's gone. 20% is the minimum. Did that put you at risk of not being able to qualify for a mortgage? Well, in 2 cases, a refinance, an investor property. If you're the kind of person that says, no, I'm just looking to buy a home, I want to live in it, this 5-year term doesn't sound like a radical change. But remember, this is a history course now. What we're going to do is take a look back at history and say, what was commonplace with default insurance in the Canadian marketplace not so many years ago? Minister Flaherty comes from a private school, Jesuit-founded background. So his attitude, I'm not surprised, is one where you have to earn things. You've got to suffer. You've got to get it on your own. So what will that mean? Well, you may be in a group of people at risk of not being able to qualify for a mortgage if Minister Flaherty takes a look back and says, oh, those are wonderful ideas. People had to suffer. They had to earn. They had to go through all sorts of trials and tribulations for salvation. Well, salvation, really, we're talking about is owning your own home. Now, who could be at risk? Well, if you're the kind of person who is taking a look at, hey, I can afford the payments based on what I've done on the internet searches and all that wonderful stuff, if you've been doing your searches based on a 25-year payoff of the mortgage, all things being equal, it's called amortization. If you've been looking at 35 years, be careful, because I said 25 years. Well, 25 years was historically the norm. What does that mean? Well, a $300,000 mortgage, going from 35 years to 25 years, that'll increase your payments that you have to make by about $300. Now that's a loan payment on a small car. So if you're thinking about buying a small car, and you do so, that $300 may stop you from owning a home, because if amortizations go from 35 to 25, you got to live in the car, not your own home. That's one major issue that may come up. What's the other one? Well, we know from the States they had some trouble with what they call liar loans. Basically what those were is people could go in and say, I make $180,000. Now they may make $10 an hour in actual fact, but they could write a letter saying, this is how much I make, give me my mortgage. And they gave it to them. Now, that caused default. So Mr. Flaherty more than likely will say, listen, there's 2 issues here. One, you haven't suffered enough. You haven't earned it. And the other thing is, I've got a $53 billion deficit. Billion. Now, how is he going to get that paid back? Well, you know how you get it paid back? Through taxes. And how do you get taxes? You tell people Listen, I don't care how well you tax planned. You started a business and your personal income says that you're making $30,000 a year. And that's what you've paid tax on. If you want one of my default insured mortgages, you better find a way to report you make $90,000 and pay the taxes on it, because I got a deficit to pay. So if you're self-employed, look at those self-employed programs under the insured programs, because they may become history. Are you self-employed and are you at risk? Now the other thing is, it used to be that you had to actually save your down payment. You couldn't borrow it. Down payment minimum requirements right now is 5%. It's still 5%. Years ago, it used to be 10%. So watch out. You may be at risk. You may have to have more savings, not now, but in the future. So you may want to do some homework now. But here's the point that I've got for down payments. Right now, you can actually borrow the down payment or take one of these mortgages that gives you cash back. That's where you can get your 5%. But look at history. History said you had to save the money, or money had to come from a family gift. So look at yourself, your down payment. If you don't have one assembled, you may be at risk. Now, where's the other at risk? Well, I talked a little bit about amortizations being shrunk, increasing payments. The other thing is that Minister Flaherty said immediately, come April 19th, you have to use the 5-year term, not the 3-year term, not the variable rate payment, to qualify for a mortgage. But so far, people with very good credit could go as high as 44% of their pre-tax income for things like their mortgage payment, property tax, heating costs, and half the condo fees if they apply. 44%. What does history tell us? History tells us that it used to be 32%. Now that's a significant drop in the allowance of what you can do to qualify. So, are you at risk? Are you self-employed? Do you have 5% down payment, and were you thinking of borrowing part of it? Do you need 10% in the future? The numbers that are going to be used to qualify you, are they going to be forever things that are going to shrink in terms of what your income allows you to buy? So, it's a history class. But the history class says you've got to do a little bit of research on what happened in the history, because that may foretell your future. And like in all classes, in all semesters, don't wait for the deadline. You've got an assignment now. Do your assignment. What is that assignment? Well, you talk to someone like Phil, the mortgage professor, and say, Phil, am I one of the people at risk? And if you are, you've got to get the assignment in, graded, marked, and graduate to home ownership now. Now you have fun, but you call and you protect yourself.